We were just talking about this, Bob, in the break, actually, that you do have a lot of things in the market moving in a positive way, coming off the boil for the inflation trade. What happens if the president comes back from Saudi Arabia and oil prices start to rise again because they're not pleased enough by whatever the result is that they're expecting?
Well, the president's pain's going to go back up. You know, he brushed off today's inflation numbers saying, oh, it hasn't caught up with gasoline prices, which have fallen in the last month, as they have. But, you know, gasoline prices are only going to follow crude. And we, like many, I think, expect we're probably going to have one more rally in crude. I think the market was too complacent about recession risks up until a few weeks ago. Now it's probably overdoing it. And whatever President Biden does in the Middle East doesn't really matter, honestly.
Really?
Saudi Arabia and UAE, they only have less than 2 million barrels a day of spare. They've already pretty much said, we gave you last month our concession. We accelerated tapering. We're done in August instead of September. We're going to keep our spare production capacity dry in case we have a problem later this year. I think President Biden's okay with that. So I think it's kind of a nothing burger a little bit in terms of new supply.
Let me ask you this. You know, it still seems like even if we got a recession, would it be enough to, you know, have global demand decline by more than that amount? I mean, you're sort of saying the supply side here is not as big a deal as the slowing in demand, but is the slowing in demand actually going to be enough to make a difference?
The price will rise to whatever levels needed to slow demand. All booms like this end in recession. When the supply side is tapped out, and it is upstream, it is downstream, the only way it ends, it's always the case, is with a recession and demand deceleration. So whether we've seen enough, it's not so clear. In the United States, the consumer is capitulating. There's an awful demand data we're seeing now in gasoline and diesel especially. But around the world, not so bad. India doing quite well, China coming back. So we don't think we've imposed enough pain yet, but this will end with demand being sort of hammered down by higher prices. The question is whether we've done enough damage already with these prices, or do we have to go higher?
Exactly, because I think it was around 2012, 2013 with the Libya incident. Oil prices were around $100 a barrel then, and there was no major economic fallout. There was no major price spike. I don't even remember there being significant demand destruction, honestly. So, you know, we could be at a relatively high, boringly, unfortunately, high price for some time. Or are you saying that we have to get to some kind of blow off top that we haven't reached yet?
I think we probably have to go a little higher. And what's different between now and, say, 2012 or from 03 to 08, when prices quintupled nearly, yet amidst growth until the very end, is product cracks are much wider. So you have these $45 per barrel spread or crack between the gasoline and diesel and crude oil. Normally that's $10 or $15 a barrel. So, you know, $100, $110 with a $45 crack is a bigger problem than if the crack were lower. So net, I think, though, we probably need one more rally, I think, into the third quarter. We're probably going to get it. You mentioned there are supply disruptions. Half of Libya has gone out. Things are not going well with Iran. Refinery runs are increasing this summer. Demand, again, outside the United States is doing pretty well. So the ingredients are there probably for maybe one more run-up, back up to $120 Brent or so, with a $45 crack. We're into the high $100 range for products. That's probably enough, and then we go down.
Shepard Smith here. Thanks for watching CNBC on YouTube.